Now, the part of the show that we have on a regular basis, I think it's a highlight for many. And these are three things that I think individual investors should focus on or consider before you make your investment decisions over the next couple of weeks. You can see here our number one topic today, U.S. bank earnings, big bank earnings out of the U.S. They're coming out at the end of this week, Friday. We're going to hear from three of the biggest banks in the United States, Citibank, Wells Fargo, JP Morgan. The only big bank really not there is Bank of America, which I believe comes out with earnings early next week, followed by Goldman Sachs and Morgan Stanley. So we're going to get a pretty good picture as to how the United States is faring when we get U.S. Big bank earnings this week. Second point I think individual investors should keep an eye on or focus on is economic data. And when I say economic data this time, I mean pretty much one data point, and that is CPI, Consumer Price Index. We're going to get CPI numbers out of the U.S. tomorrow. And what is the CPI number going to look like? Well, we've seen PCE, which is another measure of inflation, coming in at around 2.6%. So getting close to the Fed's target range and falling back a little bit. What is CPI going to say, right? Most recent numbers have CPI above 3%. Can we get CPI back to where it was at the start of the year, which was in and around 3% and actually below? I think that would be fantastic. And our third point, last point to discuss today, should investors still buy into this market at current highs? A question I've been getting a lot of, especially as the market continues to make new highs on a regular basis. So let's delve into the first point, U.S. big bank earnings. And, as I said, the big banks give us a pretty good indication as to how the economy is faring. They're the bloodline of the U.S. economy. Banks are usually, the big banks are the bloodline of any economy. And we just went through what we have, which is what we see as a one-time or an annual stress test. The Federal Reserve puts the big banks, I think last year was 23 banks in the U.S., the 23 largest banks. This year, as many as I believe 31 banks met the criteria to go under or go through this stress test. And what the Fed does is it increases the unemployment rate dramatically. It increases interest rates dramatically. It paints a very bleak and very difficult scenario for the banks. And then it says, do the banks have enough capital to be able to withstand or weather these harsh conditions? And we found out that all the banks, I believe it was, 30 or 31 banks, passed the stress test, and they were all fine, which is great to hear. In past years, we always found that maybe one or two did not pass and had to do certain things to raise capital and do other things to get a passing grade from the Fed. This year, they all passed. And once they all pass, what does that do? Well, it gives them a green light to be able to do things such as buy back their own shares or increase dividends. And we're going to get into that shortly, but many of them, actually all of them, all the big banks, I think the 15 largest banks actually raised their dividends, some of them small, some of them larger. But overall, the banks are going to report earnings starting off this Friday. And it's interesting to note, if you compare the banks, and I'm expecting some good numbers, by the way, I'm expecting some really good numbers to come out. But if you compare the banks and the bank earnings as to what we're expecting to other sectors of the U.S. economy and the S&P 500 in general, you'll find that the expectation is actually below what we're expecting for the S&P in general. And our first chart shows this. And if you look here, U.S. banks kick off earnings season, which is our first chart. And you can see here that financials, which is in the bright color, comes in below what we're actually expecting overall for the S&P 500. We're expecting earnings growth of 10.5%, S&P 500, and the financials are actually under 9%. Largest, growth, or the most growth we're expecting is out of the communications area, over 21%, info technology, 17%, and healthcare. Actually a strange one to see because we know healthcare stocks, some of them have done extremely well, like the Eli Lillys of the world, Novo Nordisk, with their weight loss drugs. But many pharma companies haven't done nearly as well as those two, obviously. And many pharma companies have been struggling. So it's interesting to see that healthcare is one of the sectors predicted to do really well, 20% growth rate. So when you look at financials, I am expecting some good data, some good numbers out of the banks. A lot of the banks are at 52-week highs. Some of the banks like JP Morgan, Goldman Sachs at all-time highs. but I think you can still take a look at some of these banks because I still believe they are relatively cheap. The next chart we'll show here, this will show us all the different dividends and the dividend increases. And you can see here at the top of the list, I know the numbers are small, but I can read you some of them. JP Morgan, first quarter dividend going from $1.15 to $1.25. Bank of America raising their dividend by a couple of cents. Here we have Wells Fargo going from 35 cents to 40 cents. You can see here Goldman Sachs raising their dividend $2.75 to $3. So all or pretty much all the big banks raising their dividends by a few pennies, a certain percentage. And that obviously, if you're an investor, is a fantastic recipe for success. So as we look towards the big bank earnings out of the US, I think individual investors need to focus on that. It definitely should be an area that investors have in their portfolio, Canadian bank stocks and US bank stocks. We won't get Canadian bank stocks really until end of August or so. But until then, I think the focus definitely should be on US bank stocks. Second point I wanted individual investors to focus on is the upcoming economic data out of the US, which is CPI, Consumer Price Index data. And that will give us a good indication as to where inflation sits. And difference between, as I say often, between the PCE data that we get out of the Fed and the CPI, sorry, not out of the Fed, but that we get out of the United States and the CPI data is real estate. CPI actually has a larger real estate component to the number than the PCE. And I think that's why the Fed likes the PCE number a lot better. But CPI going to be released tomorrow morning. And what is it going to tell us? Is it going to give us a number closer to 3%, or is it going to be status quo? Our first chart that we have here is or shows you where CPI is right now. You can see there it is, core CPI 3.4%. The headline number 3.3%, down a little bit from over the last couple of months. So that's a good sign that we are starting to see CPI fall. Our next chart here, which is one that we continue to see, and it really doesn't change, which is the point of putting it up. We see a flat line on the far right-hand side. Interest rates haven't gone up, but obviously they haven't gone down recently. So we have a big spike up followed by a flat line, and that is the Federal Reserve keeping interest rates as is. Compare that to Bank of Canada, which is our next chart. And again, you could see a flat line, but then you see a little tick lower on the far right-hand side of this chart, showing the first interest rate decrease in Canada to 4.75, our inflation rate 2.9%. So again, pretty big gap, just like in the US. There's that big gap between 5.5 and 3.3. We're seeing 4.75 and 2.9. So overall, the CPI number tomorrow morning is going to be a market mover, and it obviously will depend on the components of the CPI, where we see the inflation numbers, but it's definitely something that individual investors need to pay attention to. Our third topic and last topic for this segment is the whole idea or question: should investors continue to invest when the markets are making all-time highs on a daily basis? And that's a tough question because we're all taught to buy low and sell high. Well, here we are. Anyone who buys in now is buying high to hopefully sell higher, perhaps. That is the goal, because we know that markets move higher over time. If you look back 5 years ago, what the highs of the markets were, you could say the same thing. Well, maybe we shouldn't buy. But then here we are 5 years later, the markets are significantly higher than they were 5 years ago. Markets are significantly higher than they were 1 year ago, 6 months ago. So it's not necessarily a good idea not to buy into the markets just because they're making highs and you'll be buying at a high point, because as we note many times, today's high point could be the lower point over the next 6 months. So you never really can tell where the market's going. And it's very important to keep that in mind. The first chart I want to show about this is just a simple chart of the S&P 500 over the past year. And really, you can see that the market is at an all-time high. We coming off of the blip in April, where we saw the markets pull back 5-6%, a healthy correction, as I like to say, and the market really hasn't looked back since then. One of the things I wanted to mention regarding buying at the current highs is that even though the market is at an all-time high in the US and we're trying to get back to all-time highs here in Toronto, we're just slightly off. The market is moving not because we're seeing a widespread gains on the index. The indices are moving higher and making all-time highs because of one area in particular, and that's technology, the big cap tech names. So what does that mean? Well, that means that even though the markets are at all-time highs, there are still many companies that are nowhere near their all-time highs. You know, the 7 largest companies, or the Mag 7, or Magnificent 7, as we known to call them, back including Tesla again, because Tesla's been on a tremendous run. Those stocks have been doing extremely well as compared to the other 493 stocks on the S&P 500, which have not done nearly as well. So even though the markets are at all-time highs, and that might give you, a little bit of a pause there if you want to invest, you shouldn't be pausing, because there are 493 stocks that are still not at their highs, or many of those 493 stocks that are still not at their highs. The next chart clearly shows this, narrowing the gap, or the earnings gap, and that's what we want to see. We want to see a narrowing of the earnings gap between the Magnificent 7, which is the brown line, or the brown bars there. The gray is the S&P 500 in general, and then the S&P 500 X Mag 7, so 493 stocks. You can see the orange, how much it's underperformed the S&P and obviously the Magnificent 7. So maybe if we focus on some of the good quality names in the orange area, the 493 stocks, not the Mag 7, then I think there are a lot of good quality names to buy into, even though this market is at an all-time high. So looking back at the question, should we be investing even though the market is at an all-time high, putting new money to work? The answer is yes. I would be looking to put money to work. You never want to time markets. You want to buy good quality names. And I think you can even look at some of the Magnificent 7 names, some of the cheaper names out of the 7 to add money to, because I think if you're looking for growth, I think you still need to own some of those big cap tech names. But overall, even though the market is at all-time highs, I still think you want to put money to work if you have the ability to do so.